The 50% principle is a rule of thumb used in technical analysis to predict the size of a price correction in financial markets. When a stock or asset experiences rapid gains, it will typically lose 50% to 67% of those gains before the price starts to rise again. Traders use this principle to identify potential entry points for buying stocks, aiming to maximize profits when the upward trend resumes. The principle is based on the common behavior of investors who tend to take profits after a significant price increase, leading to a correction. It is most effective for short-term trading, as relying on this principle for longer periods can be risky due to unexpected market events. For example, if a stock rises from $100 to $150, the 50% principle suggests it might fall back to around $125, losing 50% of the $50 gain before continuing its upward trend.